right, let's get this party started. This is Justin Paolini for FCI Markets, and I want to welcome you to today's webinar. Today we're going to talk about a simple swing trading system from A to Z. Now, before we start, let me just go through the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, just a little reminder of why we are doing these webinars here at FCI Markets. We want to give you the tools to become consistent traders and help you simplify your trading habits. Too many traders spend too much time on the wrong aspects of trading systems, and they keep going around in circles for years on end, never really getting anywhere. So what we're trying to do here with these webinars is to give you simple but consistent rules and tips that can actually help you get ahead. And the benefit is that once you do reach consistency, then you can come to us with your track record and qualify for a fully funded account, and therefore making the transition from being a profitable retail trader to becoming a professional trader. So that is the pathway that I strongly suggest following. And in today's webinar, we're going to go through a swing trading system that is extremely simple, and it is with full rules, and I just really hope that it enables you to start your trading career in 2021 on the right foot. Just a little reminder, if you want additional information above and beyond what you can find on our YouTube channel, then just sign up for our free course, which we've put together for you. That's at fcimarkets.co.uk/promotions/free course. And you can download it. It's in a series of lessons, and I've put my entire experience into this course for you, and I know it'll bless you. It'll help you on your way to becoming a consistent trader. And then finally, you can also come to our Professional Trader Academy, which is where I personally help people achieve consistency through a combination of on-demand video lessons, live webinars, and interaction via email. So whatever you need, we're there for you. And without further ado, today's session is on a simple swing trading system from A to Z. Let's start with the objectives for this system. Okay, it's a swing trading system, so it's for people that have to trade around a day job and that have little or no time to follow the markets. And it only takes like 15 minutes per day. I've timed myself when I was creating this for you, and I rarely went over 15 minutes per day doing the scanning and adjusting, etc., etc. It is basically 100% rules based, and there is minimal discretion available. There is a trend filter, there is a setup, and there is a series of rules for trade management to follow. So there really is very little that can go wrong if you stick to the rules here. The other objective is that this system, although being, actually, because it is so simple, and because the rules are being clearly laid out, this system helps you become disciplined. And through that discipline, you can achieve a consistent track record. Now, so many traders go down the wrong path, consistent for a season, and then they just get derailed completely. Or they think that after one or two bad trades, the rules aren't working anymore, and they have to change something. This just keeps people going around in circles. So my encouragement is to remain consistent with the rules that you'll be seeing today, and be disciplined and stick to your guns time after time after time until you do have a track record that can either prove to you that it works and that if you just stick to the rules, things will be fine in the medium to long term. Or if you find that you really can't stick to the rules, well, at least you've given it a try. And I don't mean for 5, 6, 7 trades. You really have to do this seriously for at least 30 trades, okay, in order to get a true feeling for the model in itself and for and what it means. The fourth step, of course, the fourth objective, after you become consistent, is to approach us at FCI Markets to get a funded account, because it doesn't matter what your trading system is. It doesn't matter what your trade frequency is. If you are a consistent trader, then there are always opportunities out there for you. So people say a picture is worth 1,000 words. Well, I'm going to show you a few pictures and describe exactly what we're doing. So I've highlighted in white the moments during this recent performance this year of the euro dollar. This is actually from May until just the end of November. And these are where the system would have gotten you into a trade. Okay, so what are we actually doing? It's very simple. We are playing pin bars within the context of an uptrend. It is that simple. Okay, we are defining an uptrend by 3 moving averages being aligned one with the other. Okay, so this is the 10-day, the 20-day, and the 50-day. Okay, so when these moving averages are aligned and price is trading above it and price pulls back to test at least the 10-day, okay, and it prints a pin bar, which is defined by rules. It is a bar that has the body being half the size of the wick. Stated otherwise, the wick is twice as big as the body, and that shows rejection. And you are going to engage the market because of this setup, and then the management rules will do the rest for you. And so as you can see, it's just extremely simple, and there's no guesswork whatsoever. This is another picture. This time this is on the DAX, because with very simple rules, it makes sense to diversify. Now, also, we are on a time frame, trading the daily candles here. We're on a time frame that really suggests diversification, because in order to get the number of opportunities you need during a typical year, in order to create to reach your objectives, basically, you will need to diversify. And with a simple system like this on the daily chart, you can diversify across indices, metals, crude oil, currencies. You can diversify across everything. And it's easy to monitor all these different instruments precisely because you're not looking for anything complex or in-depth. Again, the system is very, very simple. So here are some opportunities on the DAX that you can see. Okay, and I'm not withholding anything from you. There are some opportunities that just didn't work out. This one here got stopped out. This one here got stopped out. This one here didn't actually trigger. So I'm showing a realistic picture of what you can expect with the system. This one here is on gold, and on gold I'm also showing you an additional filter that we will talk about for this system, which is the volatility filter. Because usually you'll notice that the better signals come when volatility is steady or declining. Okay, high volatility situations are more where mean reversion systems come into play. Instead, what we like to target is more a calm trending market, and that usually happens when volatility is declining. And now I'm defining volatility here in a very simple manner with the Bollinger Bandwidth. Okay, this is a standard indicator You can find it for MT5. You can download it. MT4 probably has it built in by now. It's been around so long. And of course, NetStation has it. So it's a very simple indicator. It just measures the difference between the top and the bottom Bollinger. We discussed this in a previous webinar. If you go back on our YouTube channel, you can see it. So it's really simple, and simple is often best. Okay, because too many traders complicate things, and the system is made to keep you on the right side. Finally, this is on cable. Cable has also had a few opportunities ever since June. This is into December, and we're going to go and see some of these opportunities more in detail now. But the rules are very simple. What you're looking for is very simple. There should be no guesswork. And now let's go and see what the rules are. The trend filter is simple, like I said. The 10 simple moving average has to be above the 20 simple moving average, which has to be above the 50. Okay, now the best situation is that you actually have these moving averages sloping upwards. Okay, so if I just go back to the chart for a moment, okay, you can see the averages are actually sloping upwards here in this moment in time. If you take a snapshot right in this moment in time, whereas, for example, on the gold it was better. On gold, you have some situations where the moving averages are a bit flatter. Okay, obviously, the stronger the trend, the stronger the slope in the moving averages, and that should give you a bit more confidence when you're taking the trades. The rules do not precisely require the upward slope, but it's something that I'm discretionally giving to you as another piece of information. When I tested this, I did not test it with the slope. I just tested it with the three moving averages, one on top of the other, for longs. Of course, vice versa for shorts, the 10 below the 20 below the 50. So that's our trend filter. Really simple. Now we wait for the setup. Okay. The setup is a pullback. So, candles that are closing opposite to the trend. And this pullback has to touch the 10 simple moving average. But ideally, there are no daily closes below the 20. Okay, so the pullbacks should be between the 10 and the 20. Okay, and no deeper than that, really. There are some exceptions in a really strong trend, but ideally the pullbacks are shallow, because that indicates that there's a lot of buying pressure underneath the market. If the pullback is deeper, it shows that the buying pressure is slightly less, and instead of being a pullback, you might actually be facing some kind of reversal. It's up to you to learn and evaluate the situations at hand, but these shallow pullbacks are usually higher odds than the deeper pullbacks. So we have trend filter, shallow pullback, and then the actual trigger, which is the pin bar. Okay, the wick is twice as big as the body, and I also want the candle to close in the top 50% of its range. Okay, so it is showing us that buyers not only came in from the bottom, pushing prices back up, but it pushed prices back up to the extent that the day closed in the top 50% of its range. So inside the day, you're actually looking at a V-shaped reversal. When you look on the hourly charts, you'll see a V-shaped reversal. Then we're going to talk about additional filters here. These are more risk management filters. The risk reward filter, okay, this is to help you when the markets are in strong trends, or when you are playing a shallow pullback near what looks like the top of a recent trend. Okay, there has to be at least 1 hour, okay, from your entry to the swing point that you're targeting. Okay, because whenever we're pulling back from a swing point. Okay, here we're pulling back from a swing point. Okay, in this shallow pullback, your trigger, okay, your trigger and stop loss distance has to be at least 1 hour, has to be at least the same as the distance between your trigger and the top of the swing. Okay, and this means that sometimes you need to have a tighter stop. You need to actually look inside the daily candle and have a tighter stop placement. And the examples that we'll see shortly take that into consideration, because standard procedure, standard operating procedure for playing a pin bar suggests that you put your stop below the low of the pin bar, but that is not always necessary, because if you can get a tighter stop loss, not only is your position size larger, but it takes less space to get back up to the swing point. So, and that is skewing the risk reward more firmly in your favor. So, going back down here, at least 1 hour to the previous swing point, just to make sure that you're not overextending your risk, and you're not trading a negative skew strategy. We wrote about that recently on our blog. And then the management rules. Once again, extremely simple. At the 1 hour level, scale out half of your position. If you have an immediate contrary signal, so within the first two, within the next day or the next 2 days, you have a pin bar against you, or a strong bearish engulfing, or some kind of strong contrary signal, just exit the trade. Okay, you want the trades to continue confirming the market's intent of moving in your favor. You don't want to stay in a trade, you don't want to stay married to a trade that is not performing. You want to free up that capital for better opportunities. Okay, so exit in full if you have an immediate contrary signal. If you're trailing your stop, so if the market has gone up for consecutive days in a row, you will exit in full if the market closes below the previous day's low. Okay, there's no guesswork. Okay, previous day's low, if the market closes below there, you exit the trade. And finally, if the market rallies or declines, if you're in a downtrend, to such an extent that you can get 3 times your initial risk or better, just exit the trade in full. What do these trades look like? Well, they usually last a handful of days. Some of them can last for a week and a half or even longer in really, really strong trends. But typically they last a few days, and you will get your scale out, and you will then close out the rest on a contrary signal. This is what usually happens. So this system is profitable at the margin because you usually get 2R on these trades. Because you usually get, the trades that do work, you scale out at 1R, then you get your 3R, and so on average you're getting 2R on the whole trade. And that's important because we don't want to be taking, 0.5R, 0.6R, 0.7R, 0.3R. We don't want to be taking, small profits on the trades that work. Otherwise, we're running a negative skew strategy. Otherwise, one loss eats into multiple profits. We don't want that. We want our profits to take care of, 1 or 2 losses. So that's what you can expect from this kind of system. Just to talk a little bit about, the kind of daily routine you can expect. Okay, when the day closes and when the next day opens or early into the next trading day, you check your open trades and you update trade management wherever it's required, and that takes very little time at all. Then you will scan the markets for new setups in this fashion, right? Indices, crude oil, Brent, metals, and that can be gold, silver, even copper, soft commodities if you trade them, and currencies. So you can scan all these different markets very easily for your setup because you either have the trend filter in place and the pullback and the pin bar, or you don't. There's no guesswork. There's no confusion whatsoever. Then you keep track of everything on an Excel spreadsheet as well as MyFXBook. MyFXBook is a free tracking system that you can connect our MT5s to, and it allows to measure, your progress on there. You have to measure your progress as a trader. And on the Excel spreadsheet, you can take notes as well about your setups, about the, which conditions were fulfilled, what you were feeling at that point in time. Now, if you made any slight changes, you shouldn't, at least for the first 30 trades. No changes, just play by the rules. But take note of whether you are executing in a disciplined fashion or something else is going on. You can take note of any personal interferences. There could be family issues. There could be some stress from your day job. Keep track of these things because they can impact your trading. And remember that a loss isn't an error. If you follow the rules and the market does not reward you, that is not a mistake. A mistake is looking at the market, seeing the trend filter, seeing the setup and the trigger, and saying, no, I don't like it. It doesn't look good. I'm not going to take it. That is a trading error because you didn't follow the rules. And only if you track your execution errors on a spreadsheet can you monitor this. Okay, it's very, very important. So, without further ado, let's go and check some examples. Okay, this is the chart of cable. I chose cable purposely because a lot of traders have talked about sterling as being untradeable recently because of the news and because of Brexit, and you don't know what's going to happen, etc. What I want to show you is that with a daily system like this, the news doesn't matter that much. Okay, it doesn't matter nearly as much as it does for intraday trading systems, and because it's designed. One of the objectives we talked about at the beginning is this is designed for people that are trading around a day job and don't have time to look at the charts. So let's go and check these examples. Okay, these are all properly filtered trades. And let's go and see what happens. So the first trade here. Okay, this was the pin bar. And now ignore the moving averages here on the 1 hour chart. Okay, this is the 1 hour chart. So we're looking inside the daily pin bars. Okay, you do not need the moving averages on this chart. They just they were on the chart because of the daily setup. So I cascaded them down onto the 1 hour. What are we looking at here? This was the pin bar. This was the previous swing point we were pulling back from. And here are two stop placements. Okay, this is the more conservative stop loss. The standard operating procedure stop loss below the low of the pin bar day. Okay, and of course you're going to trigger above the the pin bar high. In this case, you didn't need to wait for the pin bar high. There was actually another momentum high that was produced just as the market was opening into the 17th of November, and you really only need to break through there. You don't need this part. You just need this. The market was already finding a bid because from the pullback low, you notice that we had a positive close, and then we had our pin bar day. So you had a couple of positive days from the low. That's showing a return of buyers to the market. And you'll notice this. You'll notice paying attention to buyers coming back in, buyers returning to the market, and the fact that we have had 1 or 2 days of positive momentum before the trigger can actually enhance your probabilities. So going back to the stop loss, you don't really need to put your stop loss back here. You can choose, and I would suggest testing this of course on your demo first and keeping track of the results on your Excel spreadsheet of what happens to your results by placing a stop loss below an evident hourly swing low from the prior day instead of just placing it below the previous day's low. You can save yourself 40, 50 pips, sometimes more depending on the currency pair, and that means that your 1R is 40, 50 pips smaller. So your position size is larger, you get more bang for your buck. And from your entry to the first scale out point, you might actually have more than 1R. You might actually have 1.5 or 2 as you have in this place. But just this consideration aside, even if you used the standard stop on this first trade, what happens is you get your 1R, okay? So you scale out half, and then this day here, after touching the swing point, it actually closes with a contrary pin bar. And so we are closing out the rest of the trade, and the trade is basically closed out at break even. So no gain, no loss. The next situation, okay, we have another pin bar, so the market is recovering. This is still the same level basically, so now we have this double top here, and we're gunning for the double top. Stop loss decisions. Standard operating procedure. Your stop would be down below the previous day's low. However, the space from your entry to that stop loss, and you're compared to the space from your entry to the 1R level, to the initial scale out level, is insufficient. So in this case, you actually need the tighter stop loss here below this most recent hourly swing low. Okay, so you have a tighter stop loss, and even this isn't exactly 1R, but the markets rally and allow you to scale out there, and they also allow you to scale out possibly at 2R, 2.2R up here if you want to benefit from this rally. And if you don't want to benefit from that rally because the rules state that you close the whole trade at 3R or better, then you just have another contrary signal, and you're closing this trade at the day's close here, essentially with 1R profit. Here's another trade. We have the pin bar. As you can see, the markets are not as strong this time around, so we do have a strong recovery here on the 7th of December. The markets, get bought on the 8th of December. They show the pin bar. These are, encouraging signals. But what happens eventually is, independently from where you place your stop this time, you're gunning for this swing point way up here, so you do have enough space. But what happens is the market breaks through your entry, and then it eventually closes basically neutral on the day, and you get out once again with minimal damage. And this is one of the benefits of this model. You won't be holding on to the losing trades, because if the market reverses immediately right off the bat, you're exiting that trade the next day. You're not holding on to the losing trade. Okay, you're only holding on when the market is actually performing and going in your favor. And it's a rule that will keep you out of a lot of trouble. And trading, remember that trading is not about getting that home run trade and getting that multiple R trade each time you step up to take a swing. Trading is about risk management first and foremost. So the fact that you are getting, for example, 1R, and then you're scratching a trade more or less at break even, you get perhaps 1R, and then you scratch a trade, you get a very small loss, and then you get another profit. That's actually building up consistency and building up a very robust track record over time. Because if it's tough to stop you out, then it's tough to get you into a big drawdown. And so your equity curve will always remain at or near the highs. You'll tend to have quite a high Sharpe ratio over time. And that's one of the things that we love to see here at FCI Markets. So now we're going to move on to a different instrument. We're going to look at the DAX. Before we go into this, let me just have a quick sip of water. There we go. So let's go and see these trades. Here you go. First trade, we have the pin bar and the stop loss standard operating procedure down here, but the market did produce a higher swing before the trade entry, so a tighter stop loss could be placed there. And you can see that it takes 2.5 days to get you 3 or 4R, potentially more. If you're using the stop loss, then of course this is more. But if you're using the standard stop loss, then yeah, you've got your 3 or 4R anyway. And it only takes 2 or 3 days of positive behavior to deliver, your multiple R return. And for a swing trading system, that's not bad at all. Compare that to the standard, long-term trend following systems that the CTAs use, the commodity trading advisors. They have horrible win rates. Their win rates are around 35%, and they need to get the big R returns on their trades to make up for all those losses. Now with this system here, you have around a 50% win rate because you're combining the trend with a pullback with a setup, something that the CTAs, the standard CTAs don't use. And by also being smart with your stop loss placement, you can get these 3, 4, even larger R trades within 2-3 days. And so you're a much more efficient trader because you spend less time in the market, but you get a decent return at the same time. So next example. Okay, here you have the pin bar. This is the higher swing low here, and that's where you can place your tighter stop. Engage the market through the high of the pin bar. The market goes up. It allows you to scale out at 1R. But then what happens is that the market actually closes below prior day low, and it kicks you out. Once again, you approximately got 1R in total because you got 1R on the first half, and then closing out approximately at the same level, you get 1R on the second half. So 1R trade. Next situation, this was a stop out. Okay, and whether you had a tighter stop here or your stop loss down here, it didn't really matter. You engage the market after the pin bar, and the market fell flat on its face. What I would like you to observe, though, okay, and this is slightly discretionary, so buyer beware. The market, look at the difference. Let me just scroll up a little bit. Okay, take a snapshot of this in your mind. Okay, look at the strength, I should say weakness, but look at the market performance when this pin bar was triggered, and look at the performance when it was triggered here. Notice the V-shaped reversal on the pin bar. Notice that there has been at least a couple of days of positive momentum because we are triggering with even this short-term 50 moving average sloping upwards. And instead here we are triggering with that 50 moving average sloping downwards, and we don't have that kind of V-shaped reversal on the pin bar day. So this is an element of discretion which you can track on your Excel spreadsheet and measure. Okay, you quantify it to see whether it actually works or it doesn't. But you can check for yourself whether the V-shaped reversal intraday adds any strength to the setup or not. Okay. But for this session, I kept things extremely simple. I didn't take that into consideration, so this is a stop out. We get another stop out this time, and as you can see, we have a situation that's pretty similar. The market comes back down. It does give us the daily pin bar, but you don't really see that V-shaped reversal intraday, do you? And the short-term 50 simple moving average is flat, sloping downwards. So there might be something there. Just a little thought. This trade actually showed a decent reversal, but the actual trade didn't trigger because the market never broke above the previous day's high, which was kind of fortunate because then we had a strong decline. Notice, however, that we were still with that longer term 50 moving average on the hourly chart, which is flat or sloping downwards. So having those couple of days of positive momentum along with when you find the trigger might actually be beneficial. So what are the next steps? The next steps here are to backtest. Okay, you take 1 year's worth of data on 3 different instruments. Okay, diversify, get into the habit of diversifying. Take an index, could be the Dow Jones. Take one of the metals, take gold. Take a currency pair. even the euro. Apply the rules without discretion and see what kind of statistics you can generate. Okay, you take note of this on your Excel spreadsheet. And to be confident, what you want to see at the end of the exercise is a 50% win rate, an average profit in total that is larger than the average loss, and a total return over the maximum drawdown that is above 3. Okay, so that means that, let's say that after this exercise on the three pairs there, your total return is 12%. Okay, ideally the max drawdown during this exercise was no more than 4%. Okay, you can amount, a total return over max drawdown of 2 is acceptable. Not great. You should always aim for 3, but you should definitely have a return that's a lot larger than your max drawdown and average profit that's bigger than the average loss. Because this ensures that you will remain profitable even with a 50% win rate. And then you forward test on a demo. Okay, you need to take this next step first and not risk real money, because you need to verify that your back testing wasn't skewed. You didn't implicitly select things, or you didn't trick yourself implicitly. So you forward test using the same rules, and you check that the results remain consistent with your findings. And finally, after that, you can start trading on a live platform, risking no more than 0.5% per trade. Okay. Now this is important because this is the key to keep your drawdowns low. And remember that we're not looking to make tons of money. We're looking to make consistent profits over time. Okay, because we want to ride out the volatility of the market. We don't want to be too concerned about the volatility of our equity curve. Okay, we want to be consistent, and we want to know that no single trade or no streak of losing trades can kick us out of the game. Now, after 20 trades, assess your results and ask yourself, are you making money? Are you following the rules, or did you bend the rules? Okay, are you comfortable? And if any changes are required, or if you have any other questions after doing this process, okay, then of course we're here to help. But the bottom line is that we've given you now through the webinars that we've done up to now, we've given you a few systems. But let's talk about today's system. This system is extremely simple. There is very little guesswork. There's very little discretion. There's no guesswork. There's very little discretion. So you should be able to execute this blindfolded. And I'd like to see that. I'd like you to send me your Excel sheets with your data. I'd like to see your results tracked on my FX book. I want to see you're actually following the rules, because your statistics and any conclusions you make only make sense if you follow the rules. If you've been changing the rules, in the interim, if you've been going off on a tangent, then your statistics don't make sense. So that's why the only mistakes are deviating from the plan. A loss is not a mistake. So before I open up the stage for any questions, just a reminder: if you need guidance, then we're here to help. We send out blog posts and morning calls and weekly calls through our blog. That's at news.fci-markets.co.uk, and you can subscribe to get these directly in your inbox. There's the free course that I talked about at the beginning of this webinar. There is the Academy, the Professional Trader Academy, and the benefit here is, of course, that there's a mix of video lessons and exclusive webinars for members, and you also have the fast track towards funding opportunities. And finally, don't forget to follow us on Twitter, where we put out the most influential market moving news, option expiries, the morning calls on there, and the occasional good looking chart analysis. As always, we are happy to hear from you. So if you have any comments or questions after this webinar, anything that doesn't come to mind right now, then just let us know. Write to us because we're here to help.